Over the last 3 weeks, Alibaba, Baidu, HUYA and DOYU reported earnings for the second quarter of 2021. We also saw a lot of news about China. We saw a lot of investors selling out. We saw a lot of red flags, so we have a lot to unpack. If you want to find out more, stick around and please smash that like button to help out the channel. Baidu beat their earnings expectations by 15% with a reported $2.38 EPS on expected $2.06. Baidu's revenue was $4.84 billion, which was just $52 million above analyst expectations and showed a 29% growth as compared to the same period last year. However, they forecasted lower than expected sales for the next quarter of between 4.8 and 5.2 billion, while analysts expected 5.19 billion, and that was not taken well by analysts. Alibaba also beat their earnings by about 15% with $2.57 EPS on expected $2.22. However, they missed their revenue estimates by $605 million and only reported 31.8 billion. This is still a 43% year-on-year increase, so it's still an amazing result. In addition, Alibaba also announced that they have repurchased 1.1 billion worth of shares and are boosting share buybacks. Both Baidu and Alibaba did great, but let's take a look at DOYU and HUYA. Unfortunately, the reports there were not that great. DOYU reported an EPS of minus $0.05, which met analyst expectations, but it's awful compared to their EPS of $0.15 over the same period last year. DOYU's revenue was $360.9 million, which beat analyst expectations by just under 2% and showed a year-on-year increase of just 0.17%. Essentially, no change there. On the other hand, HUYA did better with an EPS of $0.16 on expected $0.14, but that's still down compared to last year's EPS of $0.21. HUYA did report good sales though, with a revenue of $456.7 million, beating expectations by almost 4% and showing a 17.6% increase year-on-year. Overall, Baidu showed the best earnings, followed by Alibaba and HUYA, with DOYU lagging at the end. Personally, I think that Baidu and Alibaba reported really good growth in both earnings and revenue. HUYA and DOYU did disappoint, but the main reason why they saw such a boost in earnings last year was due to increased marketing during lockdown. However, despite these results, we still saw horrible, awful price action. So far in August, all 4 companies have slipped by a lot. HUYA is down 24%, Alibaba is down 19%, Baidu is down 18.6% and DOYU is down 16%. By definition, anything above 10% is a correction, above 20% is a bear market, and 30 or 35% and more is a crash. Over the last 6 months, all of these stocks have crashed. DOYU has fallen by 79%, HUYA by 66.5%, Baidu by 60% and Alibaba by 38%. They're not even being shorted that much. This is how one-sided the sale is. Basically, as you can see, things are not looking good for these Chinese stocks right now. Actually, things are not looking good for most Chinese tech stocks. It is definitely not because of the fundamentals, because all 4 of these are rock solid in terms of revenue, earnings, financial health and so on. So, why the horrible price action? What's happened? Well, more recently, we saw several things. First of all, the Chinese government has been cracking down on tech since the end of last year, which spooked a lot of investors. However, up until a couple of weeks ago, it seemed like this was coming to an end. Unfortunately, the Chinese government announced their new 5-year plan, which aims to improve regulation in sectors like tech and, quote-unquote, establish higher requirements for the construction of a government under the rule of law. That 5-year plan is meant to be promoting legislation against monopolies and foreign rule of law, and also resolve antitrust issues with the Chinese tech and education sectors. Long story short, this plan means that the next 5 years will not favor investors in Chinese tech companies. We can see that the Chinese government is already putting the plan into place, as they announced a new personal data privacy law that will come into action on November 1st, 2021. They also just announced new antitrust rules, so we can see that they've already started implementing more restrictions. Secondly, the current chairman of the SEC, Gary Gensler, put out a video that described the reality of investing in China. By Chinese law, foreign investors cannot directly own shares in Chinese tech companies. These tech companies like Alibaba, Baidu, HUYA and DOYU get around this by establishing shell companies and using them to raise money on American stock exchanges. Essentially, you end up investing in a shell company, not in the actual company, which is something that those companies have not really mentioned. Furthermore, whenever a company is public, they need to get their financial records audited. However, to prove that the audit was correct and fair, the auditors are also sometimes audited. This is something that China has not allowed for the last 17 years, and the SEC has currently decided to essentially stop any new listings of such Chinese companies on American stock exchanges. As you can expect, investors took this as a major red flag, as they should really. Most people are familiar with the reality of investing in ADRs or American Depositary Receipts. They are usually risky, but Chinese ADRs take this one step further. To make matters worse, Cathie Wood and a number of other investors have fully sold their Chinese holdings. Personally, I take this as a big warning sign, especially as Cathie Wood is one of those permanently bullish investors. Seeing her selling out of stocks like that is just worrying. Thirdly, China reported a slowing GDP growth and higher PPI inflation. Given that there were a lot of high expectations placed on the Chinese economy's growth, these news were not taken positively by both analysts and investors. This is attributed to extreme weather, the Delta variant, and so on, but the reality is that growth has slowed down while inflation is going up. Essentially, it is starting to look like China may be headed for a stagflation scenario, where prices and inflation rise much faster than growth. It's still early to tell whether that's going to be the case, but that is what investors are expecting, so the markets are reflecting it. China has taken steps to combat this by releasing their material supply of metals like copper, iron, and aluminium, which has had the effect of lowering prices for those metals. As a result, copper and iron miners like Rio Tinto have seen very negative price actions as well. China seems to be committed to keeping the prices of these metals low, as high prices will hamper not only their economic growth, but also a lot of their infrastructure plans for the near future. It's important to follow this as well, because China is the biggest consumer for those metals worldwide, and their prices can directly affect the Chinese economy. Obviously, by proxy, they will also affect inflation and producer prices across the rest of the world. So, what does all of this tell us? What can we do? I have to say that just a month ago I was really bullish on Chinese stocks. However, seeing how the markets are turning, seeing all the news, it's hard for me to be bullish anymore. There are times when the market is trying to scare you. Most of the times it's a trick to get you to sell. This time, however, I don't think it's a trick. It is time to sell. I have sold all of my Chinese holdings at a roughly 25% loss, and it sucks. It really does. However, this is simply not something that you can expect. The news were handed to us with little warning and showed China's complete disregard for the stock market. There is just too many factors going against Chinese stocks to hold them. In addition to everything I have shared so far, we can also see that the G7 are adopting plans to rival China. The US specifically is implementing a lot of anti-China policies. They started a couple of years ago with Trump and his trade war, but they did not stop there. Biden has made it clear that he will be putting measures in place too, subsidizing American semiconductors, stopping imports of solar panels from specific regions in China, taking back control of the supply chain, and reducing reliance on Chinese imports for production. And, as I said, China is not helping its own case. Their recent political actions have simply made investors afraid of putting their capital in China. Investor sentiment is probably at an all-time low when it comes to China, and it will remain low, in my opinion, for the next few years. While this is going on, none of the big investors will want to touch a Chinese stock or ADR. As a result, prices will go down and stay down. They will stay down for a long time, possibly years, which will incur a lot of opportunity cost for anyone who decides to hold. It's annoying because the fundamentals of some Chinese businesses are looking great. They're performing well, but the stock price just keeps on tanking, and that's purely due to politics and regulation. I really want to be bullish and hold, but I can't. There is so much uncertainty around these stocks that they're simply not a viable investing choice right now. In fact, an emerging markets index fund is probably a much better choice given the current situation, or, even better, an American, European or global index fund. Obviously, that's not financial advice, that's my personal opinion. What do you think? Let me know in the comments below. If I've missed out on any news, feel free to link them below. If you haven't already, please like, comment and share the video. Thank you for watching and I'll talk to you again soon.